What's up, everybody? My name is Ivory Orr. I'm an entrepreneur and investor. Now, one of the areas that I invest in is the stock market. And what I find is what scares most people about the stock market is that it all sounds so complicated. My goal is to take these complicated topics and make them simple for everybody to understand. Today, we're going to discuss three types of stocks that you've probably heard about: mutual funds, index funds, and ETFs. And we'll discuss the difference between the three. Let's go. Thank you for watching Mind Your Biz with me, Ivory Orr. Now, there's a lot of channels on YouTube about all kinds of things, but this channel is about building wealth. I'm talking about changing lives by changing bank accounts. Now, if you're on the same page that I'm on, go ahead and hit that like button, hit that subscribe button, and hit that notification bell so more people in our community can see this message. Now, today, we're talking about three stocks that you've probably heard of, but have no idea what they really are. And that is a mutual fund, an index fund, and an exchange traded fund, or an ETF. Let's break them down. Let's start with mutual funds. A mutual fund is just a company or fund that picks a bunch of stocks, packages them together, and sells them to you for one price. So anybody who's ever bought cable from Comcast or AT&T or Spectrum or any other cable providers, I'm sure you're familiar with bundles. They sell you your internet, your cable, your telephone, all for one price. Well, mutual funds work the same way, but with stocks. Somebody takes a bunch of stocks, puts them in a bundle, and sells them to you for one price. Now, the stocks that go into that bundle are picked by what's called a fund manager. So that's some expert who's been doing stocks for years, some Ivy League graduate that decides, hey, I think these stocks are going to perform the best. I'm going to put them all in one package and you can buy them for one price. So that's a mutual fund. Now, the downside of the mutual fund is that fund manager receives a fee, and he or she receives that fee whether or not the stocks that they pick do well for you or not. However, the upside is you got somebody who knows more about stocks than you picking the stocks. Now let's talk about index funds. An index fund is actually a type of mutual fund that is passively managed. All that means is there's no fund manager picking the stocks that go into the bundle. Instead, the stocks that go into an index fund follow an index. An index is just a list of stocks on the stock exchange. For example, the S&P 500, which you've probably heard of, is just a list or index of the 500 biggest companies in America. So when you buy an S&P 500 index fund, you're just buying an index fund that includes the 500 biggest companies in America, and you're able to buy all of their stocks at one time. Now, the upside of buying an index fund instead of a mutual fund is that because the index fund is passively managed, the fees are lower. Now, one thing you need to know about index funds: the shares of an index fund can only be traded, that means bought or sold, once per day. And the price of an index fund is determined by the last price it sold for when the stock market closed that day. So if the stock market closed and the price of that index fund was $100, then if you buy an index fund that day, that's going to be the price. And last, let's talk about an ETF, or an exchange traded fund. Now, an ETF and an index fund are so similar that many people use those terms interchangeably, right? They're both passively managed, so you avoid the fees that come with a fund manager. But there are a couple of differences. The first difference is, like I told you, an index fund can only be bought and sold once per day, right? An ETF, however, is traded like a stock. That means as long as the stock market is open, an ETF can be sold several times per day. Now, the other difference is because it's treated like a stock, then if you go through a broker, then every time you buy or sell that stock, that ETF, you're going to get a trade fee or trade commission. Now, the good news is if you use a free trading app like Robinhood, M1 Finance, or there's several others out there, you can avoid a lot of those fees. Now, just like an index fund, some ETFs follow an index. So yes, you can buy an S&P 500 ETF and it will have all the 500 biggest stocks in America, right? But however, ETFs can also follow a sector like energy or technology or communications. So for example, energy ETF might have all the stocks like Chevron, Exxon, BP. You get it? A car ETF might have Ford or Tesla. You get the picture. So ETF can follow an index or it can follow a sector. Guys, it really isn't much more to it. It really is that simple. These are three types of stocks on the stock market that are very similar and they all have their pros and cons. Now, whichever one you choose, the important thing is that you start investing now. The best time to invest was yesterday, right? Money in your pocket is dead money. You're losing money because it's not keeping up with the rate of inflation. Money in the bank is doing the same exact thing. It's not keeping up with the rate of inflation. So whatever you do, start investing now, whether it's real estate, entrepreneurship, you're starting a business, and if it's the stock market, these are three types of stocks that are great for beginners. With that being said, I want to thank you for watching Minding Your Biz with me, Ivory Orr. If you like what you heard, please hit that like button, hit that subscribe button, and hit that notification bell. Until the next time I drop a video, I'm out. Peace.